Intel stockholders recently received a crucial update from the management team regarding significant changes to the company's expansion plans and cost-cutting strategies. These adjustments come as a direct response to investor feedback, particularly in light of growing frustration following the suspension of dividend payments earlier this year. With investor patience wearing thin, Intel's management recognizes the need for decisive action to rebuild confidence. Key changes in expansion plans. One of the major steps Intel is taking involves refining its foundry manufacturing expansion. The company has invested billions to build its foundry business, which is set to produce semiconductor chips for external clients rather than solely for internal use. While this hefty investment raised concerns among shareholders, management has stated that operations across 3 continents have laid a robust foundation for a world-class foundry capable of supporting the AI era. Intel is transitioning from a phase of aggressive investment to a more measured approach, emphasizing a flexible capital plan. Most notably, the company announced a 2-year pause on projects in Poland and Germany. This delay allows time for market demand to stabilize and enables Intel to enhance its cash flow. This shift reflects a more cautious strategy compared to the more ambitious plans pursued over the past couple of years. Despite these delays in Europe, Intel remains committed to its manufacturing expansions in the U.S., particularly in Arizona, Oregon, New Mexico, and Ohio. Bolstered by substantial government subsidies. Focus on stability and profitability. Management is acutely aware of the pressures stemming from a steep decline in operating income, which has plummeted from over $2 billion in the trailing 12 months to just $500 million. This dramatic fall in profitability, coupled with several quarters of losses, necessitated the pause in dividends. Investors have been vocal in urging management to prioritize stabilizing cash flow and profitability before pursuing further expansion. Intel is betting on its investments in AI, particularly in leveraging its strong position in AI data centers and cost-effective inferencing solutions. The company believes that as businesses invest in training large language models using high-performance computing, they will increasingly seek more economical chips for inferencing tasks, which Intel is strategically positioned to provide. Organizational restructuring. In addition to scaling back investments, Intel is also implementing significant workforce reductions, planning to let go of approximately 15,000 employees by the end of the year. Management has indicated they are more than halfway to achieving this target. This downsizing will also facilitate a reduction of about 2/3 in Intel's global real estate footprint, generating further savings. The shift towards remote and hybrid work environments can yield significant cost reductions, allowing companies to minimize office space expenses while providing employees with the flexibility they desire. Intel's decision to downsize its office space is a pragmatic step toward enhancing operational efficiency. A significant transformation. In summary, management described this period as Intel's most substantial transformation in over 4 decades. The changes being implemented are both extensive and risky, reflecting an ambitious attempt to reposition the company for future success. However, the current skepticism among investors regarding the potential returns on these investments has contributed to a decline in Intel's stock price. This period of transition carries inherent risks, and while Intel is making strides toward recovery, the ultimate success of these changes remains uncertain. As Intel navigates this critical juncture, it will be essential for the management team to demonstrate that these strategic shifts will yield the expected benefits. Investors will be closely monitoring how effectively Intel can stabilize its operations and restore profitability in the coming months.